Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged. Thanks so much for tuning in today. I know how valuable your time is, so I appreciate you spending some of it here with me today. I also just want to thank those of you who have left an honest rating and review in iTunes. Not only are they really helpful for me and the show, but many of them are also quite funny. So I decided to put an automatic stream of the last 5 headlines that I get in these reviews on my website, so go check them out. I'm sure you'll find that they will put a smile on your face too. On today's show, I'm talking to Marc Malek, founder of Conquest Capital Group. Marc was originally given a grant by NASA to study how to optimize the position of tanks in a battlefield to increase the chances of winning the battle. But as his background had taken him away from a real war zone in Lebanon, he was at the last minute encouraged to spend his time looking at stocks, bonds, and currencies instead. This lucky break became the beginning of a long career in the financial world, working for some of the largest financial institutions before setting up his first independent venture in 1999, which led him to where he is today. Now, for those of you who are new to the show, I just want to let you know that you can find all of the show notes, including a full transcript of today's episode, on the toptradersunplugged.com website. Now, let's get started with part 1 of my conversation. I hope you will enjoy it. Marc, thank you so much for being with us today. I really appreciate you taking the time.
Thank you, Niels.
You're welcome. Now, as I was preparing for our conversation today, I noticed a couple of interesting things that I'm sure we'll have a chance to discuss. But just to give you some of my initial observation. Now, it strikes me that you have quite a large number of different strategies that you offer, both in the alpha strategy space, but also some alternative beta strategies, which to me suggest that you have diversified your business into more of a, can I call it a solution-oriented firm rather than being more a standard type of alternative investment company. The other thing I noticed was that you began your career working for some of the very large institutions in the world, yet you chose the entrepreneurial path, and I can imagine that's quite a change in itself, and I'd love to hear more about that. And then I also noticed that you developed this risk aversion index, which I find very interesting, and would certainly like to spend a bit of time discussing these things. But so you know, I'm excited about all these topics that we can talk about. But before we go into that, and before we find out where your company is today, I would really love for you to take us all the way back to the beginning of your story and tell us about what led you to take this path in life, and really feel free to go back as far as you want, Marc.
Sure. It's a fairly interesting sort of path that led me to sort of where we are today.
Okay.
But before I get started, again, thank you, Neil, for giving us this opportunity. All the points that you mentioned are definitely something that we can get into, and each one has sort of its own particular story.
Great.
But starting with the background, originally I'm from Beirut, Lebanon. I graduated from Caltech in 1992. At Caltech, I was studying neural networks and decision support systems.
Mm-hmm.
I was sort of very immersed in that field and definitely planning on, getting my PhD in the field and continuing my research there.
Mm-hmm.
In my junior year at Caltech, I received a grant from NASA's Jet Propulsion Laboratory, which is one of the 8 NASA centers in the U.S. that Caltech runs.
Okay.
The grant was to basically study how you can position tanks in a battlefield to optimize your chances of winning based on a new mathematical technique called scenario analysis.
Right.
The person who was doing the leading research in the field of scenario analysis was a professor at the University of Wisconsin in Madison. So I traveled over the summer from Caltech to Wisconsin, to Madison, to do the research with him. We sort of, before we started, he's getting to know each other and finds out I'm from Lebanon and says something like, we just came from a battlefield. Do you really want to spend the whole term looking at tanks and battlefield?
Yeah.
Why don't you apply the grant to the optimization problem of something like stocks, bonds, and currencies? Mathematically, it's the same project, whether you're using green tanks and blue tanks and yellow tanks or stocks, bonds, and, commodities or FX. It's really the same sort of mathematical work that needs to be done. So, said fine. At that point, I really didn't know what a stock or a bond was. I sort of never spent any time looking at any of this stuff.
Sure.
I remember I had to go out and get a book that actually, just gave me the definitions of these things. We didn't have Google back then.
Right.
So I did my research, ended up writing a paper that was published at the university, and went back to Caltech to sort of finish my senior year. In my senior year, I was very excited because I was finishing the top of my class at Caltech, and I had the highest job offer from Oracle to go and work there for a couple of years before going back and getting my PhD. Actually, back then, Larry Ellison was still signing the offer letters, so I still have that letter from him.
Fantastic.
So I was very excited. I had the highest job offer from anyone at Caltech, which I think at the time, this is 91, was about like $45,000 or something.
Right.
Sometime in the spring of my junior year, I get a call from somebody calling from New York. Says, this is so and so. I'm calling from Solomon Brothers, and would like to invite you over for an interview.
Okay.
I was kind of shocked at first, but it turns out that they had read my paper and wanted to interview me. So it's fine, free trip to New York. I went to New York with absolutely no intention or no understanding of what the job was. Anyway, to make a long story short, I sort of fell in love with the whole concept of, trading and money management. It's sort of the way, at least I understood it,
Sure.
from a couple of days in, interviewing.
Yeah.
At the end of those couple of days, the MD pulled me in the office, says something like, we normally don't do this, but everyone likes you and we're going to make you an offer on the spot.
Okay.
Which was, quite a bit more than what Oracle had offered.
Right.
So that was sort of the beginning of how I got into this whole thing. Quickly, sort of very shortly after I got to Solomon, because I was hired in research, I realized that I'd much rather be on the trading side than the research side. So I left after about a year and change to join an ex-Solomon trader that had started a hedge fund back, in the early 90s.
Okay.
He hired me basically to develop trading systems for him and trade currency options. So I did that until about end of 94, beginning of 95. When I was hired by UBS to start and run the sort of an global group in exotic derivatives,
Right.
which on foreign exchange, which essentially were all, every derivative that goes beyond a simple call or a put.
Okay.
I did that until 97 when UBS and SBC merged, at which point I was promoted to run the combined banks prop trading groups in London and the Americas. Prior to that, in setting up the global exotic derivatives group, I had set it up in New York initially, then moved to London, set it up there, then moved to Tokyo and set it up there, globalized it, and ran it from Tokyo until I got promoted to run the prop trading groups. I moved then back to London. And that was, around sort of that 98, and sort of, if you remember the turmoil in the markets in 98, sure. And the bank had lost a lot of money, which really cemented my decision to leave. I was thinking about leaving before that, but seeing sort of the effect on my own compensation and limits and things like that from things that were happening in other parts of the bank.
Right.
Basically, kind of cemented my view that, I think on Wall Street, you have maybe, 5 to 10% top producers that pay for probably 80, 90% of kind of mediocre or below average people.
Sure.
And if you're kind of vain enough to think of yourself as that, top 10 or 5%, then really by working on Wall Street, you're subsidizing everybody else.
Right.
So I decided to leave and start my own firm. And sort of that was the beginning of me into the hedge fund world.
Right. Did you know what you were going to do at that stage? I mean, did you know from day one, this is exactly how I'm going to do it? Or was it more like, okay, let me...
No, absolutely. I mean, prior to doing that, I had ran quite a substantial global prop trading group at UBS. I had, about 18 traders, each one senior in their own rights, that reported to me. In my own trading at UBS, actually starting from my days at the hedge fund, in the sort of 93, 94 area time.
Sure.
Going to the period where I ran exotic derivatives at UBS, which also included a large portion of prop trading, which really was the reason why they promoted me to run the prop trading groups afterwards. Throughout this whole process, I had developed and used systematic models to trade in the market.
Right.
I've always had the philosophy that, if you look at basically any successful discretionary trader, they don't sort of, wake up randomly one day and decide to put on a position because they had a dream, or, maybe some do, but
sure.
usually not the successful ones.
Sure.
Usually it's a thought process that leads you to put on the trade. You look for certain things to happen either technically or fundamentally. When these conditions are met, you put a trade on. When you put that trade on, ahead of time how much you're willing to risk on that trade, what position size you need to have for that risk, and where the stop on it should be, and where your take profit on it should be.
Sure.
Now, when you list all these things one after the other, it really, it's no different than kind of the algorithms that go into creating a trading model.
Sure.
So I think with a lot of the very successful traders, if they had sort of the mathematical and computer background, they can very easily turn a lot of that thought process into an algorithm. And once you have it as an algorithm, then it's very easy to program it. And at that point, a computer is a much more efficient tool to execute your own view for a variety of reasons, stretching from taking the emotions out of it, to efficiency of execution, to giving you the flexibility of trading many more markets that you cannot follow yourself, but a computer can do it in a much easier way, and so on. So I've always had a very systematic approach from my days at UBS. So on day one, when I left and went on my own, I had, a suite of ideas that I knew I wanted to start with and work on. And also, when I started, I had a partner at the time. And he also came with his own ideas. And basically, our product was, a combination of a lot of brainstorming into kind of the background that I brought and the background that he brought.
Sure. And let me just ask you, it's just sort of a spur of the moment question here. When you explain why people, if they had the knowledge of programming or putting together sort of systems rather than trying to just do it by sort of as a discretionary trader, even though they might use internal rules in their own mind, which obviously is a very, very logical way of doing things. But why do you think it is so difficult for systematic traders to explain to investors that they shouldn't be worried about the fact that we use computers to do this, and in fact that it isn't a black box?
Well, it's a very good question. I mean, I don't think it's difficult for a systematic trader to explain their strategy. I think there are a lot of systematic traders that deliberately try to be very opaque about what they do,
right?
For a variety of reasons. One of them is they don't want to give away kind of the secret sauce of what they're doing. And I think to a large extent, in the sort of old school trend following world, primarily it's sort of to keep how simple it is from getting out and making people realize, why on earth am I paying 2 and 20 for that?
But that's from the manager side, Mark. But on the other hand, I would argue that investors, they have a difficulty with accepting, these systems, and they try to make them in some ways more complicated by calling them a black box. So I think you're right about the manager side. That's probably one reason. But I think also the investor side is a little bit to blame here, that they don't embrace the fact that technology, like if you board a plane, the pilot's not going to sit there for 12 hours flying the plane manually. He's going to use an autopilot. And I think most people would prefer he uses an autopilot.
Well, I mean, look, I think that is changing over time.
Okay.
I think there is a sort of much sort of wider acceptance of quantitative strategies now than there were before.
Right.
I mean, look, to use your example of the plane, passengers know that, the pilot is relying on a lot of analytics and tools to fly that plane. But the most important thing is they know that there is a pilot.
Yep.
That if something goes wrong, the pilot can turn off whatever machines are there and just fly the plane. I think with systematic strategies and the way that, a majority of them are sort of, explained and portrayed, is that people are fond of saying we're 100% systematic. And when you say 100% of anything, it tends to make people nervous because, look, systematic works maybe, 95% of the time, but sometimes you have some events that can happen, that can hit the world, and it could be either endogenous type events or exogenous type events that are unforeseen. Now, again, 99% of the time, you want to follow your system because that's basically the reason you build them. And, the world usually is really not that different. However, I mean, the way we describe our strategy is we say we're about 95% systematic and 5% discretionary. And the reason we do so is, again, to use your analogy of the plane and the pilot, investors like to know that, yes, you might have kind of the highest tech equipment, but they want a pilot in charge.
Yeah.
And, the example I give there usually is that, look, we're systematic 95+% of the time, but if I'm sitting in my office and my models are screaming to buy stocks and I see a plane heading into a building, I might choose to turn off that model at that point.
Sure.
Just common sense approach. I mean, The other point that that I think confused a lot of investors, and partly, I mean, let's take an example.
Sure.
If you look at sort of traditional trend following, sort of the turtle approach to trend following.
Sure.
Slap a couple of moving averages together, a short-term one and a long-term one, apply it to 50 of your favorite markets across 4 or 5 different sectors, and you've got yourself a hedge fund. Historically, from kind of the 70s until I would say the early 2000s, that's pretty much what all CTAs did. You can check that by looking at the correlation and the return of CTAs during that period to the very simple model that I just gave you. Sure. It's about 80%, and it's a very consistent 80%.
Sure.
Now, some people, when you take a trend follower, I mean, it's a very simple tool that I just gave you.
Sure.
So a lot of people might want to get into the space. They don't really want to question why trends happen. They just know that this exists, and that if you do this, you're going to make money. And they start a fund, and they go out and start trying to get investors. Now, investors also at the same time, they can sit there and was like, well, this black box, they don't even know what's, how it works. But the explanation that, the manager gives at that point is that, look, we know that trends happen in the world. Our models take advantage of trends, and they make money when there are trends. And, historically, we've made a lot of money and so on. So, in that kind of process of the whole, from the manager side as well as from the client side, there is a lot of uncertainty. So the clients, they say, well, why do trends happen? How do I know if they happen before they're going to happen again? And when you're sort of having that conversation with a manager that is sort of, very orthodox in their approach, that, look, I don't know why trends happen. I don't care what they happen. They happen, and that's how we take advantage of them, which is really was the way a lot of people kind of answered these questions.
Right.
It creates that, lack of understanding and I would say people just sort of, if you're not comfortable with an investment, it's going to be very difficult for you to get to invest. So what ended up happening for, a lot of CTA investors is that at the initial kind of pitch, they passed. Then they saw CTAs making a lot of money. You go through a period, make, 40, 50% for a year or two. Then, so they get dragged into investing, kicking and screaming, at which point they're kind of investing at the top in these strategies,
sure,
which by definition are very cyclical. And then only to, see their investment plummets in value because they pretty much bought the top at the top of the cycle.
Yeah.
And given that they didn't understand, exactly what they were buying, they don't have a conviction to hold, as it's coming down. So they basically get out at the bottom. And we saw this cycle happen so many times with investors who would always buy the trend followers, at the top and sell it at the bottom. I mean, in my cynical side sort of says that over time, investors as a group have lost money investing in CTAs just because of the timing. Now, using that same approach, I mean, the way I would explain it is that, look, first of all, looking at CTAs, even though we trade, 50, 60 different markets, for any decent-sized CTA, our bread and butter comes from the financials. So you're talking global fixed income, you're talking currencies, you're talking equities. Commodities are a nice diversifier, but that's pretty much what it is, a diversifier. Now, if you look at any economic region, US, Europe, Japan, non-Japan, Asia, every one of those regions has its own business cycle. It has a certain either growth or declining economy, and the business cycle around that sort of, think of it as let's say it's a growing economy. So you have an upward sloping line, and the business cycle oscillates around that line.
Sure.
Now, in each one of those economic regions, the job of the central bank is to minimize the amplitude of that business cycle relative to the slope of the line.
Right.
Meaning, if a central bank is hugely successful, then they keep their economy on that slope of the growth.
Sure.
There is no volatility.
Sure.
Now, obviously, no one is that successful. So what happened is, as the business cycle goes up, central banks, as the business cycle, let's say, starts going quite a bit above that slope of the line.
Sure.
Central banks come in and try to increase interest rates to slow things down.
Sure.
Once they, and when you are at the bottom, below your growth trend, they come and lower interest rates to essentially bring you back up.
Yeah.
Now, when you look at the way a central bank it changes interest rate policy, it's not, plus 50, minus 25, plus 75, minus 10, plus 5, minus 10, plus 5. That's not how they do it.
Right.
They go plus, 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 stop.
Yeah.
They stop for a while. Then they go minus, 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 stop, and they stop for a while. Now, think of what happens whenever a central bank embarks on these cycles. Well, every time, let's say they start with a plus, there is a wave that starts and propagates through all the financial markets. So it changes in interest rate policies have effects on currency prices, they have effect on stock prices, they have effect on bond prices. So now you've started the beginning of a trend.
Yeah.
Now, when they come again and they do another 25 or 50 and so on, now your trend is getting momentum. Then it goes again, and now the trend is getting more momentum. And then they stop, and that's when your trend kind of, levels off. And, in a perfect world, that's when your position reverses, and then you take it on the other side.
Yeah.
Now, unfortunately, that would have been too easy if that's exactly how things work.
Sure.
But what happens is, for every market moves for two reasons. It moves for alpha reasons and it moves for beta reasons. Alpha reasons being conditions that are only relating to that market, and beta reasons are the overall kind of macro condition or policy, interest rate policy, and so on. So what I described in the action of the central bank, that's macro, that's beta. Now, if in the absence of any alpha reason, then we'll get perfect trends and everything would work fine. Except that, things are not that easy. So every market, again, has its own alpha reason. Now, you get the best trends when both the beta and the alpha are pointing in the right direction.
Right.
Now, so let's think of what would make a perfect trend. Let's say you're looking at crude oil. Now, we know that in a very hot economy, an expanding economy, there is a natural pressure on crude oil prices to go up as there is more business activity, more manufacturing. So that's an upward pressure on crude oil prices. Now, let's say in the middle of that happening, you get a giant explosion in Saudi Arabia that causes, crude oil to spike for local reason, just for, something like supply reasons. Sure. Or just, So then you get a real kind of turbo boost to that move that was happening in crude oil. And you get really the perfect trend at that point. Sure. Because you have both alpha and beta kicking in the same direction.
Yeah.
When you get really bad trends is when they're completely opposite. Where, the alpha and the beta are kind of fighting with each other. And you get these, choppy markets where you're constantly getting stopped out and back into position and stopped out. So really, even something kind of as for a lot of people, trend following is a very opaque strategy. But really, it's not. I mean, it's not alchemy. It's the concept for it is rooted in simple economics and finance.
Sure.
And I think once, sort of in my experience at least, once I've explained it to investors, they generally sort of agree and then they get it. Now, the next thing I say is that, look, given how simple this strategy is, it's really not a 2 and 20 strategy. People have gotten away with too much over the years, charging 2 and 20 for this. So what happened, in the early 2000s, I spent a lot of time doing research on, how to extract more alpha from long-term trend following. And I kept getting to the conclusion that the best or the most efficient way to get more alpha from trend following is to essentially not charge 2 and 20. So I wrote a paper in the early 2000s how using very simple off-the-shelf trend following techniques like moving averages or breakouts or things like that, and some other very simple portfolio technique, you can build a very sort of reasonable and high expectancy trend following strategy, and that if you don't charge 2 and 20 for it, you end up having results that beat sort of 80-90% of the trend followers out there. We wrote the paper in the early 2000s, like I said, and published it. And in 2004, we were approached by the endowment of a very large Ivy League university that agreed with our premise and asked us to start a fund for them based on that. So since 2004, we have had a fund that's basically a very well-diversified trend following strategy that charges a flat 1% management fee and no incentive fee. And since we've launched it, it had 70-80% very stable correlation to the trend following indices. And that Ivy League endowment, it's still the biggest investor there.
But let me, that's a very interesting observation. I think it's as I mentioned in the early part, it's one of the things I'd love to discuss with you, because you were certainly one of the early adopters on this. But here's my question about it. To some extent, I feel that managers will have this alternative beta or this CTA replicator to give investors very similar returns to the CTA indices, but at a lower price, and that's fine. There's nothing wrong with that. However, I feel that the CTA indices themselves, because of the underlying CTAs, have changed, and therefore I'm not so sure that these replicators today are very I say it a little bit, but I'm not so sure that they track the CTA indices as well as they used to do, simply for the fact that I think CTAs have changed. And I think that's another thing that you have made observations about, and that is that managers today have migrated from being pure trend followers maybe to doing other types of strategies, in particular in the last few years, to compensate for maybe lack of trends in the usual sense. So I don't know whether you think that that's an issue, or whether, and maybe do these alternative beta strategies or CTA replicators, do they themselves actually need to be evolving, and maybe you do them differently today than 10 years ago when you started?
Look, absolutely. That's a very sort of astute observation. What happened is, if you look at trend follower correlations from kind of the dawn of trend following until, let's say, kind of the early 2000s, or early to mid 2000s, I would say, they were a very homogeneous group. You'd be hard pressed to find CTAs with less than 70% correlation. In some cases, it was more than 80 and solid. The reason for that is that pretty much all of them followed the same kind of turtle methodology of long-term trend following. And, with all the good and the bad that strategy entailed.
Sure.
Now, starting in the mid-2000s, there were a couple of changes that some CTAs started doing that led to what I call sort of the split in the CTA space between what I call the old school and the new age CTAs.
Right.
The old school are the ones that stuck to the turtle approach. The new age guys changed things in a couple of ways. One of them is fairly technical. Not sure how much we want to go into it, but essentially it has something to do with the fact that, look, basically, historically, CTAs kind of size their position in any given market in a relationship that is inversely proportional to the volatility of the market that you traded.
Right.
Meaning, you wanted to take sort of the same risk per trade. You wanted to risk, let's say, the same amount in your crude oil trade than you did in your euro dollar trade.
Yeah.
But these two markets have vastly different volatilities. So you can't take the same dollar position size in them. So what you do is you adjust it for volatility, and then you take a vol-adjusted position.
Yeah.
Now, what happened is that, the old school way of doing this is you had your position, you stuck your position until that trend reversed, and then you exited and, you reverse into the opposite side with the new position size at that point.
Sure.
Now, one of the biggest criticisms for CTAs historically has been that CTAs have high volatility, large profit give back, big potential drawdowns. Now, what eventually became the new school guys started kind of thinking about the problem. They correctly realized that, the volatility at the beginning of a trend is fairly low. As that trend matures and starts sort of showing sign of weakness and reversion, volatility goes up significantly. So essentially they said, look, it doesn't make sense that we are taking a position at the beginning of a trend when volatility is low, and therefore we would have a relatively large position size, and holding the same position as the volatility in this trend itself is changing, which is causing us to have the higher vol on the portfolio and so on.
Sure.
So they said, what if we do more frequent sampling of the volatility and adjust our positions accordingly?
Yeah.
So the thinking there is that you'll be sort of taking profit on your position as the trend is developing, and then by the time volatility spikes and the trend reverses, you go through that reversal with a very small position and therefore minimize the effect on your portfolio, which is great, except that it leaves one sort of gap in the thinking. Now, it automatically assumes that that an increase in volatility is a precursor to a trend reversal and not a trend continuation.
Sure.
Now, if that sharp rise in volatility actually is a precursor to a trend continuation, then the rest of them are going to basically sit out that trade, which probably will be at a time when CTAs are the most needed, which is when volatility is really high, but then going even higher.
Yeah.
Now, an example of that is what happened in 2008. In 2008, if you remember, volatilities spiked quite a bit going into the summer, the end of the summer.
Yeah.
By then, a lot of these kind of new school CTAs had pretty much exited a lot of their position because of the volatility spike. But then what happened is we had Lehman Brothers, and then really volatility exploded at that point.
Sure.
So what happened is all these guys ended up missing once in maybe, I don't know, 10, 20-year opportunity in the CTA space. And more importantly, they did not deliver the protection to their investors that is sort of part and parcel of what investors expect from a trend following investment.
Sure.
Now, so if you look at, I won't go into which manager is new school versus old school, but that's one way to look at it.
Sure.
Now, the other big change that they've made is that they, again, correctly realized that trend following has very distinct characteristics that work in certain market conditions, which are really in many ways negatively correlated to a lot of other strategies, which is really, when you think about it, is why the pitch that we make to investors of why they should go into trend following strategies, because it's low correlation or negative correlation at some point. But these guys said, well, if we include in what we're doing a negative correlation strategy, we're going to improve our risk-adjusted return. So to give you a very simple example, if you take a simple turtle model of, moving average-based turtle model, you add to it something as simple as a long S&P position. You can, maybe not just purely long S&P, but long risk. You can improve the risk-adjusted return of what you're doing, except that you'll be really deviating from investors' expectation of what you can do in different market conditions. Because at that point, when volatility spikes in the market and risk aversion spikes, you're not going to be delivering the protection that they thought they were getting with you.
Sure.
So what we noticed, the two large changes that we saw in CTA starting in the mid-2000s, is that you had one half or one group that stayed true to the turtle approach. Those are the guys that did really well in 2008. And then you had another group that did two significant changes, which is the position size adjustment based on volatility, as well as adding totally different strategies that are long risk with negative correlation profile to trend following into their own fund. And these are the guys that have done very well in the last 4 or 5 years. Now, the question is, are investors investing in CTAs as just an absolute return strategy, in which case they would go with the new age guys? But then in which case I would argue that if you're investing in CTAs as an absolute return strategy, then really you should go look elsewhere, because there are other hedge fund strategies that do better on an absolute return basis. Or are investors investing in CTAs as a portfolio tool that works very well against the rest of what they have in the portfolio? And in which case, CTAs really have to stick to what investors' expectation is of their performance in various market conditions.
Sure.
Now, to give you a practical example, when we noticed it's a long answer to tie back to your question.
No, that's fine. That's perfect.
Which is when whether CTAs are tracking or not, or whether trackers can should change or not. Well, when we noticed this a few years ago, we went back to the Ivy League endowment and presented the numbers and said, look, this is what we think is happening. We think that you can have better risk-adjusted numbers from us overall if we add a long risk strategy to what you do, which we already had, because in our other fund, in Conquest Macro, we have a very successful long risk strategy. Said, it's a very easy thing for us to just kind of, turn it on for you in this one. And you will be getting, then the fund will switch from being kind of a turtle approach to being a new age approach. It's really not rocket science. It wasn't rocket science to do turtles, and it's still not rocket science to do kind of the new age approach.
Sure.
And the answer from the endowment was a resounding no. They wanted us to stick to the turtle approach precisely because they used us as a portfolio tool. And they wanted, they said they have long risk plenty in their portfolio. They think they are a better judge of what long risk strategy to be in than us with a generic long risk strategy. So they wanted to retain that flexibility in what they do. But they wanted us to continue to deliver the characteristics of what their expectation is from a traditional trend follower, which is fine. So you mentioned that we have a lot of products. Well, the reason we have a lot of products is, look, the way I think of sort of portfolio construction, it's a two-step process. A portfolio is made of individual models. I think we are very good at creating different models that do different things in various market conditions. Maybe it's sort of having 3 young children spending a lot of time with Legos. But I think of these models as Lego pieces.
Right.
Now, you can take those Lego pieces and put them together to make a plane. Then you can take it apart and put them together in a different way to make a submarine or a car or a house.
Sure.
As long as you have good, solid Lego pieces, you can build them to create any profile that you want, which is exactly what we do on a portfolio basis. I think we are very good at making these Lego pieces. They're very solid. They're good quality pieces. But the construction of them is really in how we want the portfolio to look, what characteristics, all that other stuff. So, if I think of our generic turtle approach as one Lego piece, a big Lego piece, and I think of our long risk as another Lego piece, each one individually can give you a very different risk profile. But putting them together, now we can go from, a turtle-based trend-following strategy to a new age absolute return trend-following strategy.
Sure. Okay, let me just say to the listeners who are listening and may not know what we refer to when we say a turtle strategy, if you go to episode 13 and 14, that's actually with Jerry Parker, and that he is probably the most successful turtle. So if you want to hear the whole turtle story, go to episode 13 and 14. But I want to ask you, Marc, to go back and then take us from where you started realizing this, and then how Conquest evolved as you were adding these strategies. What were your thinking behind adding this particular one as a separate offering, and so on and so forth? And before we leave your story as a whole, I think we need to go from the inception of Conquest and to where we are today before we dive into sort of more the specifics. But I'd like for you to tell us that story, how the product range sort of evolved in the last 10 years.
Absolutely. I mean, look, all that stuff that we spoke about so far, that was just almost like a side project for us.
Right.
That has never been our bread and butter.
Yeah.
That's something that started out of an intellectual exercise, which, we had the luxury and privilege of being kind of the first one to test it and bring it to market. And now you can see how many different people are adopting that approach.
Absolutely.
Historically, our bread and butter has been Conquest Macro.
Okay.
When I first started, I've always wanted to have, let me backtrack for a second. If you look at pretty much over 90% of investment strategies, they all tend to do really well in low risk, low volatility environments, and they get slaughtered in high vol environments.
Right.
So, periods like 98, anytime there was sort of, shock in the market, you see a huge, a very universal suffering from pretty much every investment strategy.
Yeah.
The reason for that is that, in a very, very simplified way, active investment, whether it's sort of, a hedge fund type and so on, make money by sort of buying the risky asset and selling the less risky asset against it, and benefiting from that. So think of this as in the stock market being long kind of high beta versus short low beta. In fixed income, you can do sort of the borrow short, lend long. A variety of ways of expressing this in pretty much every single market. Now, while those strategies, let's say whether you do it in fixed income or whether you do it in equities and so on, while they have low correlation most of the time when environment is not very risk averse, their correlation goes to 1 on the downside whenever risk aversion rises. The reason for that is that each one of those strategies that is benefiting from buying the risky asset and selling the less risky asset needs one very crucial thing for it to work, which is liquidity. Liquidity is like the oxygen for these strategies. Now, when there is oxygen, each one is doing its different thing, low correlation, everyone is happy. However, when risk aversion rises in the markets, one of the first casualty of a rise in risk aversion is liquidity.
Right.
Liquidity dries up significantly. So what happens is that suddenly all these strategies that look to be uncorrelated, where in reality they did have one common risk factor, which is liquidity,
right,
but they start all losing money at the same time. That's when investors start scratching their head. It was like, well, what happened? We thought we were diversified. Why are they all losing money at the same time?
Sure.
Well, the reason is because they're pretty much all long a lot of liquidity, and when that disappears, they lose at the same time. And we've seen that happen, many time and time again.
Sure.
So my thinking about Conquest Macro from the beginning was I wanted a product that would do well in risk-averse periods because it's needed. The majority, like I said, over 90% of strategies out there don't have that profile. Now, historically, the way people hedged some of that, rise in risk aversion is they, could have allocated, let's say, to short sellers. Now, the problem with short sellers is that stocks go up over time, and it's pretty much a negative expectancy strategy. Very few short sellers survive for decent parts of time.
Sure.
And look, markets can go up for, as we saw in the last few years,
Sure.
for a significant period of time. I mean, Keynes has never been more right than now.
Right.
Markets can be much more, go much longer than it can be much more irrational than it can be solvent.
Yeah.
And the problem with short sellers is when you have that type of strategy, it's not, given that markets can go for long stretches of time, let's say going up in this case, investors find it very difficult to hold on to a short seller over that period of time, just every month losing and losing and losing. So they end up redeeming out of their hedge, probably just at the time where they needed it the most.
Yeah.
So, short selling is not sort of an ideal hedge to portfolios. The second strategy that people allocated to kind of hedge some of that risk aversion risk was pure long volatility strategies, just buy vol.
Yeah.
Now, that was great in the 80s and 90s when I believe vols were mispriced. I kind of cut, that was pretty much my career until, I went off I traded volatility.
Sure.
And it was mispriced. However, in the 90s and the early 2000s, we made significant headways in not just understanding volatility and the jump in vol and, second derivatives and so on, but we also, with computers and all these kind of models out there. I mean, whatever edge we had in the models that we had built to give us a better kind of mousetrap for measuring volatility, by the end of the 90s, early 2000s, everyone had them. So as a result, I think volatility became much more correctly priced. Now, if you assume that volatility is correctly priced and your strategy is based on just buying that, then really you have zero expectancy. But if you factor in transaction cost and things like that, you end up with a negative expectancy. And again, when you look at sort of investment in pure long vol strategy, I don't know if any of them still exist, but they had that characteristic of bleeding, losing over significant periods of time, and then generally investors redeemed before vol spiked and they made a lot of money. The third one that people allocated to was trend following,
right?
Long-term trend following. Now, there is, I think, a big misconception out there is that investors believe that long-term trend following is a long volatility strategy. It's not. I actually wrote a paper on that. The paper was published and it won the Best Paper Award by Institutional Investor.
Okay.
I think it was published in the Journal of Alternative Investments.
Mm-hmm.
Long-term trend followers are long the second derivative of volatility.
Mm-hmm.
If a volatility event happens and that event is sufficiently large, then it can kick into place trends that can go for quite a distance and over time for trend followers to really benefit from them. So think of what happened in 2008. Now, an example where trend following made money, but you could have just as easily lost money. Let's say go back to September 11, 2001.
Mm-hmm.
When that tragedy happened, trend followers made money. But the reason they made money is that when September 11th happened, obviously stocks went down and bonds went up, just to kind of simplify things.
Sure.
However, the markets, the trends in stocks and bonds had turned, a few months before into short stocks and long bonds.
Right.
So when you got that exogenous event, which was September 11, it basically, again, using our example of alpha and beta,
sure.
The beta was correctly in place, and that was an alpha event that really pushed everything in one direction.
Sure.
Now, if September 11, 2001 had happened a year before, when long-term trend followers were long stocks and short bonds, they would have gotten destroyed.
Right.
The point I'm trying to make is that long-term trend following is not long short-term vol,
right?
But it can be long, very long-term vol or the second derivative of vol.
Sure.
However, that doesn't hold true. In another piece of research that we put out and was published in a book by Risk Books in London in 2008, what we proved is that when you come down in the trend following spectrum from the long-term trend following to the very short-term trend following, starting, 1 month and under, essentially trend following strategies that are very short in duration start acting very much like pure long volatility strategies. I'm sort of simplifying a little bit,
sure.
But the whole paper is available. I think you might be able to find it online or through Risk Books in their book.
Okay.
So, looking at kind of the what's available for an investor as protection against short-term risk and volatility spiking or risk aversion and so on, really there wasn't any good product out there.
Right.
And that was the idea why with Conquest Macro, we wanted to have a product that essentially had two mandates. The first one, and very important one, is to be an absolute return strategy. Because if you're not a good absolute return strategy, investors will not hold you long enough to fulfill your promise, basically.
Right.
And the second mandate was to try to generate the bulk of that absolute return in what we call periods of risk aversion, which are periods of high volatility and high volatility of volatility.
Right.
Now, our expectation for the fund is to return somewhere between 5 and 10% in risk-seeking periods, in low-vol environments periods, and return over 30% in risk-averse periods.
Sure.
In our actual trading, since we started, we have annualized over 30% in those risk-averse periods. We have checked that box.
Sure.
Now, on the risk-seeking side is where we've had to do a lot of work to improve our strategies. So depending on when you look at our track record, and so we've had many improvements that happened over the years.
Sure.
I would say that our actual track record is probably flat to slightly positive in risk-seeking periods, which by itself is still a very significant improvement over short sellers and long vol strategies.
Sure.
But looking at, our track record since we've made a lot of the improvement in our risk-seeking performance, that's tracking closer to 5 to 10% annualized. So if I think of our return based on our risk index and our analysis of the risk environment, we model the world to be roughly about 70% of the time risk-seeking, low vol, and about 30% of the time risk-averse.
Right.
So just quick back on the envelope calculation, if the 70% of the time that you are risk-seeking, you're going to make 5 to 10%, call it 7 and change average. You're going to make roughly 5% in that period. Then in the 30% of the time that you're going to make 30% from your risk-averse performance, you're going to make another kind of 9-ish%. So I think we're kind of a 14-15% type strategy over time, but with a very, very important portfolio benefit in the way that we deliver those returns.
True. Here's a question. I mean, that obviously is very, very interesting, that trying to design a program that not only gives investors the bulk of the return when they most need it, but actually also can make returns when they don't really need it. But obviously, it's an absolute return strategy, and therefore it's nice to have an absolute return through those periods. So in a sense, you could say it's the best of both worlds. Now, with traditional trend following, my observation is that it can't deliver both. I mean, there's simply going to be a period where it will lose money. Of course, the question is then, how much will you lose, and so on and so forth. But it's kind of universally, I think, accepted that trend following can't be the best of both worlds. It sounds to me like a very tall order to try and do both. How do you achieve that?
I mean, look, it's a lot of very hard work and a lot of trial and error. And I mean, in a way, 15 years on, I think we have the best product we've ever had. And I think it's both an ability to design individual models that over time will deliver exactly what, not the return, but the risk profile that you expect. I don't understand how anyone can kind of promise a certain return profile, because really returns are a function of what the market gives you.
Sure.
And no one really knows ahead of time what the market will give you. Our biggest effect comes on risk control. If you build up a certain risk profile, that risk profile is going to be associated with different return in different market conditions. So I start with, that concept. And what we do is we have, I think, our risk index. One of the biggest benefits that we've sort of reaped in the portfolio was when we came up with the idea of the risk index. And again, at that time, very few people thought of risk indices or even had a risk index.
Why did you want to develop that, Marc?
Well, it was very simple. I mean, in trying to have the best product that responded very well in periods of higher volatility, we wanted to have a quantifiable way to go and measure what we defined as high volatility versus low volatility.
Was it more to visualize to people, or is it something that you use in the actual program?
We use in our actual program.
Okay.
So the premise before we built our risk index was that different strategies do differently in different risk environment.
Yeah.
If we had a proper way to measure the risk environment through a risk index, we can use that to affect our risk allocation methodology across the different strategies within our portfolio, and therefore have a better portfolio.
Yeah.
Simple premise. So the first step was to go out and say, because historically when people kind of looked at risk, they looked at it in sort of individual pockets, meaning either through the prism of the VIX but really VIX is only equities.
Sure.
Or through, FX volatility for people who traded, FX options, or swap spreads for people who did, more fixed income. But people were not kind of looking at a much more comprehensive view of risk.
Right.
What we basically observed is that, look, one of the benefits of having a risk index is it really kind of pushes your tentacles across all the different parts of the capital markets. On a daily basis, you're able to measure the temperature of pretty much all the different areas, from liquidity risk to credit risk because the way we define it, said, okay, well, what are the different risks that people kind of look at? Well, you have liquidity risk, you have credit risk, you have emerging market risk, you have equity risk, you have foreign exchange risk. So when you have a much more comprehensive view of these risks, it gives you a much better way of assessing market vulnerabilities, let's say.
Sure.
Because a lot of the time, depending on where the risk aversion ends up coming from, you start seeing sign of that in that particular, dark corner of the market way before anybody else starts kind of feeling it or seeing it. So it gives you some preparation time to go and think about what you want to do and how you want to do it. So once we built our risk index, it turned out that sort of intuition was spot on, which is that there is very strong statistical evidence that different strategies consistently do very different things in very different risk environment. And that there was a certain level of autocorrelation in the risk index that kind of allowed you to use some of that information. Now, in periods of switching from one risk environment to the other, there is, the expected noise in the data around those points,
right,
which is not something insurmountable. You can very easily filter out that noise. But once you got into the body of a risk environment, your probability of staying in it was much higher than the probability of reversing, until you had an event that caused it to reverse. And again, you go back to that noise and so on. But what we found is that using an asset allocation strategy greatly benefits our return, because it allowed us to put our resources where they had the highest expectancy given the risk environment.
Sure.
And given that, we thought we had a very good mousetrap for figuring when the risk environment, what it is, what it's telling us, and when it's changing. As a matter of fact, we put these changes in our portfolio in March of 2005. And measuring the effect of those changes for the next few years, it ended up improving our risk-adjusted returns by about 30%.
Right.
Just that one change alone.
Sure.
Now, once we were able to see the benefit from allocating to different strategies that have different risk profile and different correlation profile using our sort of risk index, it spurred us into going out and creating a lot more strategies, sort of more Lego pieces, let's say, that do different things in different risk environments. So, when we first came up with our risk index, we had three sub-strategies within Conquest Macro. We had a long vol strategy, we had a short-term trend following strategy, and we had a non-trend and a counter-trend strategy. Now, using the risk index, what we found is that in risk-averse periods, our best performer was our long vol component,
right,
which makes
sense.
Perfect sense.
Yeah.
However, what we also found out that in risk-seeking periods, short-term trend following ends up doing significantly better than long vol, because even in very low volatility environment, you still have some short-term trends that you can take advantage of.
Sure.
What we also found, and this again caused me kind of to scratch my head a little bit at first, but when I put in our risk bucket that has in it both counter-trend and non-trend strategies, on the surface, it showed no effect of the risk environment on that sub-strategy. which kind of puzzled me for a little bit until we dug down at the individual model level because each one of those sub-strategies has many different models. What we found is that pretty much half of the models were affected in one way and half of the other models were affected in another way. And the net effect was no change in that risk bucket, which again, made sense. And because if you look at our long vol sub-strategy, individual models there have correlations, let's say between teens to kind of 50, 60 or so.
Right.
If you look at our short-term trend following risk bucket, again, correlation probably 40, 50, 60, and so on. In both of these, all positive correlation. Therefore, you really saw a clear effect from the change in the risk environment. When you look at our non-trend and counter-trend strategy, it has both strategies that do really well in risk-seeking periods and strategies that do risk-averse periods. Therefore, it has as components negatively correlated strategies to each other. Therefore, the effect from the risk environment was kind of neutralized by having the component be negatively correlated to each other. Now, as I said, we made the changes to go from static risk allocation to a dynamic risk allocation based on the risk environment. We improved our returns by about 30%. However, the way I viewed that improvement was more like the sort of improvement you get from cost cutting.
Right.
It was just, a better rearrangement of the deck chairs.
Okay.
But I still wanted a component that actually added positive returns in risk-seeking periods.
Yeah.
And that's where we went out and built our fourth sub-strategy, which is what we call long risk, which is a strategy that essentially has about 80% correlation to hedge funds.
Right.
That uses only futures and FX. That as a standalone could be a very good product by itself because, again, it gives you a Sharpe of about 80% correlation to hedge fund using only futures and FX, which as a standalone strategy would qualify it as a CTA.
Sure.
So you can be technically invested like a hedge fund, but getting a tax treatment of the CTA.
Right.
And which is, by the way, in our product offering, we also offer it separately as a standalone. But it was hugely helpful to the Conquest Macro portfolio because now we had one more risk bucket that we can allocate to in risk-seeking period that really would give us, pure, simple, absolute return on the positive side. Now, the rest of the evolution of the models within Conquest Macro is, historically we started off with only price-based models. Slowly, after, wouldn't be so slowly, but after about, 7, 8, 9 years, we progressed into an area that we call quant macro, which is models that take a combination of two things, fundamental data as well as technical data. And that, again, allowed us to have, more leeway on how to allocate within the different risk environments and so on.
So you have these four strategies inside the macro program. Are you able to kind of visualize and talk just briefly a little bit about what, how each of them, what they do, so to speak, just to make it sort of maybe simplified a little bit?
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.